Hello investors, my name is Rishi and welcome back to another episode of investing. Finding optimal entry and exit points on a stock chart may be difficult, but with the help of certain tools, we can maximize the amount of profit that we make by determining certain patterns in a stock's prices. To determine these patterns, we can use tools such as Trendlines, support and resistance, and supply and demand zones. So today, I want to give you a walkthrough on how to use these tools and consistently determine the patterns in a stock's prices. Alright, so the very first thing that I want to cover today is support and resistance. Support is a price level where the price of an asset has struggled dipping below due to a high demand for the asset, acting as a barrier or a floor. These levels that can cause potential spikes in buying power are often displayed on charts through lines near the price level. These levels can be determined by analyzing historical data and finding where these areas of asset strength lie on the chart. Support plays an important role in determining strong entry points for traders who are looking to profit off these recoveries and trend reversals. Alright, so here I just pulled up an Amazon chart over the 195-minute time frame, and I wanted to show you a prime example of support. First off, when you're trying to draw support levels, you want to see that the asset price has reversed at least twice. When you can see that this level has been retested, this is a sign of a strong support or resistance level. So here we can see that the price was consolidating in this tight range until it ended up pivoting around $126. The price aggressively moved upwards and then eventually ended up coming back down and pivoted upwards again at that same level. This is what gave us confirmation to create a potential support level. So if I take this segment and if I draw from end to end of both candlesticks, we can see that price ends up bouncing around this level and then even comes back to bounce again for a really aggressive move upwards. Now we can expect that in the future, if the price ever comes back down towards that level, the price can potentially shoot upwards due to this valid support line. But beware, when a level has been tested many times, don't assume that it's getting stronger and gaining a higher efficiency. In fact, it can be argued that a large number of retests can cause a level to get weaker. In the case of support, this is due to the fact that most of the limit buy orders, which are directions given to a broker to buy security at a specific price level, get filled at the support level price, causing a dry up in the amount of investors interested in buying at the fourth or fifth retest. So just remember to keep that in mind. Next, let's move on to resistance. This is the polar opposite of support. It's a price level where the price of an asset struggles climbing above due to an increase of share selling, acting as a ceiling. These levels are also represented as lines on the charts, and it's common to see asset prices going into a pullback at this point. Resistance is just as important as support, except acting as a strong entry point for investors to go short or take profit on their long positions. Alright, so here I've just loaded up a 4-hour chart of the Spider S&P 500 ETF Trust, and I was able to spot an amazing example of resistance. Alright, so first off, we can see that there was a nice pullback, and then there was also a huge reversal that was following that at the same point of the original pivot point. So this is what allows us to create our potential resistance. And so if we place it here, we can see that even a year later, the price comes up around this level at around July of this year, and we can see that this resistance line was successful and the price came right back down. Support and resistance breaks are when the price of an asset crosses over or under the drawn level. A support break suggests that a downtrend may be accelerating, while a resistance break indicates an uptrend could be gaining momentum. While you may think that this automatically invalidates the support and resistance lines, this is not always true. Oftentimes, the price may just cross over the levels by a small amount and then end up reversing back within that previous range, which is known as a false break. These false breaks don't really create genuine signals for price reversals, and it's also very important to consider that support and resistance don't have to be exact lines and can also be zones. Price can't always be so precise, and zones accommodate this market noise. To avoid these misleading breaks, investors use confirmation strategies to understand the price action. For example, high volume during breakout or breakdown candles imply that greater participation and conviction among the traders is present, making the break more reliable. In addition, the time frame size matters. A break that's meaningful on a shorter time frame might not have the same impact on a longer one. Alright, so on this hourly chart of NQ futures, we can see an example of a broken support. Alright, so we could see that there was a pretty nice support here previously, following these 3 points and their respective upward movements. And there was also actually a resistance over here. So let me draw that in. And so the price was moving between these two, the support and the resistance. And eventually the support ended up breaking. And so previously we said that a broken support leads to a downtrend, and that's what we see here. A very important market signal that you should know is that when you recognize a valid break in a support level, this level's role has now potentially become a resistance and vice versa, and this is called a support and resistance flip. If we take a look at the present price, we can see that there's a lot of selling pressure on the price. So this actually could be a reaction of touching this broken support, which may have turned into a new resistance level. The reason this makes sense is because investors who had long positions expecting the price to bounce up from a support will suffer a loss if the price breaks the support. When the price comes along back to that level, investors will try to cut their losses, making the broken support act as a newly formed resistance. Alright, so for my last example of support and resistance, I want to show you a daily chart of Rivian Automotive that is absolutely stacked with different types of signals. Alright, so on this chart, we can see 2 different examples of broken support and resistance, as well as an example of a false breakout. So if we take a look, we can see that this blue line was previously used to act as a support level, as we can see multiple touches of this line. We can also see this false breakdown here. The price did come below the support level, but there was no follow through, nor was there any high volume. Following this, we can see an upward reversal all the way until this support level was broken on high selling volume. This is what confirmed that the break was not false. This broken support then continued on to act as a newly formed resistance, as we can see 5 to 6 touches of this line, which makes it extremely strong. When approaching the resistance level here, we can see that there was very high volume and a very aggressive move upwards, breaking this resistance line and deeming it invalid. The price almost doubled from around $15 to $29. That is the end of the support and resistance section. Now that we've finished support and resistance, let's move on to trend lines. A trend line is a technical analysis tool that uses a segment to connect multiple price points together, and this helps to visualize the strength and direction of an asset's price trend. By connecting the lows in an uptrend and the highs in a downtrend, a trend line can also help traders to identify levels of diagonal support and resistance. I'm going to use this daily chart of Spider S&P 500 ETF Trust to determine how to draw a proper trend line. First, you want to try to find 2 or more connecting points to formulate a clear trend. So the higher lows would be an uptrend, and then the lower highs would be a downtrend. So here, I can see that each of the peaks gets lower and lower every time. So we can say that that is a downtrend. So I'm going to take this trend line and draw it to connect the highs. And so you always want to make sure that the trend lines stay linear and stick close to the price movement. Catching the overall direction of the trend is really important. So getting a trend line angle similar to the overall asset price trend can help to clearly assess its stability. We can see that this entire move took place over the course of a year, and this is clearly a downtrend, which we can see from this trend line. And then of course, for validation, we need to confirm this with multiple line touches in larger time frames that have more importance and reliability than the more volatile short-term price movements. And this is a daily chart, so that's pretty good. And we have around 5 touches, which is basically perfect in this scenario. Because this is connecting the highs of the price, this also kind of acts like a diagonal resistance. We can see here that every time that the price touches the trend line, there is a reversal. And so we see that one here, all the way continuing to here. And then when it comes back right to this point, it goes into another downtrend, and same again right here. Here's a monthly chart of QQQ, and this is what I like to call the mother of all trend lines. Over more than a decade, the price has remained above this trend line, and this trend line has been acting like a support. As you can see, we have one touch, and then it remains above, continuously going upward. Then in COVID, it actually ended up touching the line in March of 2020. It touched the line and then reacted on the support, and it ended up going upward again. And then the 2022 bear market is right here, and then started moving towards the line, towards the line, towards the line, touched the line, and then starts going upward again. So this is a very, very large time frame, and the price is still remaining above it. This asset has grown over $350 over a decade, and this support working even after this many years is just phenomenal. I also wanted to cover a subcategory within Trendlines, which are trendline channels. These show the price action of a trend within a range, helping to show the movement path of a price by using the main trendline and the parallel ones running along it. Alright, so the example that I'm going to show is on a daily chart of Apple. Let me show you how to draw these channels. So we select this channel button, and if to be more specific, we go into this channel section and click parallel channel, and then we draw a trend line that connects the highs of the trend. So connects the highs like that, and then one that connects the lows. And there. So by using trendline channels, investors can figure out a range that the price tends to be trading within, displaying the price fluctuations within the upper and lower bounds. By also watching the steepness, we can determine how strong this trend is. If the angle is sharply upward or downward, the trend is very strong. If the angle is not as steep and more moderate, the strength is just not as high. We talked about support and resistance just prior to this trendline segment. It ties in very well with the topic, as the upper bounds of a channel can act as diagonal resistance, while the lower bounds can act as a diagonal support. This presents investors with so many entry opportunities, showing them that they can tend to be profitable if they go long at support touches. And in this case, every time that the price touches the support, investors should be adding more positions so then they can just continuously make more profit. I also want to cover the fact of when to close your positions. There's a really good strategy that you can implement if you use the moving averages that we discussed in the last video. So here I'm going to turn on a 20 SMA, which is a simple moving average with the length of 20. So let's turn that on. And so if we analyze this, I think that on this candle is where you should sell. And the reason I'm saying that is because on this candle, it breaks through the channel and also crosses underneath the 20 SMA, which means that the trend that you can see right here is not as strong anymore. And this is eventually confirmed as we can see a pretty big drop in price following that break. That completely sums it up for this trendline segment. Alright, so now let's move on to supply and demand zones. As covered in a previous episode, the definition of supply and demand is a fundamental economic concept that describes the relationship between the availability of a certain asset, which is supply, and the desire of buyers to purchase that asset, which is demand. The change in both supply and demand is what actually moves these asset prices. If there's high demand for a stock and a limited supply of shares available for purchase, the price is likely to rise. Conversely, if there's low demand and a plethora of shares for sale, the price will likely fall. In this episode, I'll talk about supply and demand zones, or areas on a chart where the ratio of supply to demand changes. These zones are identified by a concentration of orders that cause brief market imbalances in price movements. This large cluster of orders occurs when many orders are left behind during these aggressive moves, creating a resisting force against the asset price. Alright, so let's start off with supply zones. Supply zones are areas of increased selling pressure from investors that reverse the upward momentum of an asset's price. As indicated by the name, the plethora of shares formed by the high selling power is known as an increased supply of the stock. Alright, so to create these supply zones, we want to find candlesticks on the chart that indicate aggressive selling following a green basing candle to use for creating these supply zones. A bullish candlestick with the body length that is less than half of the distance between its high and its low is said to be basing. So basically, we're looking for a green candlestick with a small body. Alright, first off, let's delete those old support and resistance zones that we were talking about earlier. Alright, now I'm going to zoom in to these two candlesticks to show you how to draw the supply zone. Alright, so right here we can see a green basing candle as there's a small body, and then we also have our aggressive move downward through this red candle. So having this basing candle and the aggressive move down is what our criteria is to draw the supply zone. So to draw the supply zone, let's click on this box, and then what we want to do is connect the top of the upper wick for the green candlestick, and then connect that to the bottom of the green body. All right, so now that we did that, we want it to extend all the way to the right so we can see when the price touches this zone in the future. So let's go to style and then press extend right. And then, so when price touches supply, the price tends to go down, and the color red represents down. So let's change the fill to red so then we can use this as a signal for ourselves. All right, so now let's zoom out and take a look at this supply level being tested. So, all right. So right here in early September, we can see that this supply level was tested. And right as it came into the zone on this candlestick, the price dropped significantly. All right, so that's it for supply zones. And now let's move on to demand zones. Demand zones are the opposite of supply zones. These are areas of increased buying pressure that reverse the downward momentum of an asset's price. The demand for a stock means that the supply is going down, causing the price to go up because investors are bidding up the price. All right, so we're currently in an hourly chart, and I'm going to switch to a 30-minute chart so then we can create this demand zone. And so if we zoom in right here, these two are the candlesticks that we're going to use to create this demand zone. So in the case of demand, we need a red basing candle and a long upward green candle. So the points that we need to connect for the demand zones are the top of the basing candle's body and the bottom of the lower wick. So if we connect it like that, and then we want it to extend right, so then we can see when the price touches it again, just like we did for the supply zones. And so this is what it would look like. And then now we also want to change the color to green, as that's what indicates the demand. And perfect. All right, so now let me zoom out and I can show you guys what happens when the price touches this zone. So we can see quite a few retests of this zone. And so for example, we have a touch here, then upward movement, and then we have consolidation, then another touch, and then a nice upward movement to here. And then we can see that the price goes to the original supply zone that we drew, goes back down to the demand zone, and then is now just moving within this range. The last thing I want to talk about within supply and demand zones is breaks. The funny thing about supply and demand zones is that there aren't really any false breakouts. The supply and demand balance can shift if a price crosses beyond the supply zone, which might lead traders to search for other zones that are consistent with the mood of the market. Similar to this, when a demand zone is breached by price, traders may look for new demand zones that better reflect the shifting market dynamics. This is why traders tend to delete broken zones and find brand new, fresh zones. Out of all the different topics that we discussed today, I think that supply and demand is the most beneficial for the trading strategy that I use. This is because supply and demand is what truly represents the market auction. Before I let you guys go, I want to explain a very important concept to you guys. And this is tendency. I've used the word tend and potential countless times throughout this video. All these support lines, resistance lines, supply demand zones, and trend lines, they don't mean anything without investor perception because they don't actually move the market. What does move the market though is the opinion and the analysis of individual investors. They are what truly move the market. These zones and lines, they tend to cause potential reactions of price. They don't guarantee anything. So I just want you guys to keep that in mind. And that wraps up this video. If you remember the video from last week, you know that we talked about indicators such as the simple and exponential moving average. Using these indicators in conjunction with the strategies that you learned today will help you to create a very strong trading strategy. Thank you so much for watching this video, and make sure to like and share this video to reach a wider audience. If you have any suggestions or questions, make sure to comment them down below in the comment section. I'll catch you in the next one.